Hi guys. So today I'm just going to focus on these two topics, the financial management function and the financial management environment. Remember where we're coming from? We had section A to section G to cover. But now we've dealt with section C, which is on working capital management. We've done section D on investment appraisal. We've done section E, which is business finance. F, business valuation, we've dealt with it. And likewise, G, on risk management. All of this, we've dealt with them and very well. We've solved questions as well. And most importantly, I'm sure you agree that these are the major chunk of your syllabus. These 5 sections alone are sufficient to pass your exams, right? But by popular demand, I've been asked to also help to summarize section A and B, just to make sure that everything in the syllabus is fully covered on this channel. And that is why I'm going to do justice to that right now. So I'm going to discuss the financial management function, which is section A, and the environment, which is section B. So in this video, I will give you every single important thing you need to understand in these two sections. There's no need to waste your time reading so much literature because everything you need to know, you will get in this short video quickly. So we'll go into it. Section A is on financial management function, and I'm going to be looking at the nature and purpose of financial management. I will talk about the key objectives and relationship in corporate strategy. And likewise, we'll look at stakeholders management. Why do we need to manage those stakeholders with diverse interests? And we'll look at the financial management environment, looking at most importantly the macroeconomic environment, which is about the nation and the global economic world where we operate as a company. So let's go into it quickly. And I will start with the key decisions that you must be able to make as a financial manager. There are 3 key decisions that you must be able to make and understand. I know I mentioned this in one of the earlier videos, but I'm going to mention it again. The first one is the financing decision. And here, what this is talking about is, as a financial manager, you must be able to advise the company where should the source of financing come from. Remember, I told you sources of capital, you just have 2 sources. From this formula, asset can be financed from liability or equity, or you can combine both. So it's either you're using liability, which is someone else's money, or you're using your money, which is equity. So as a finance manager, you must be able to advise a company, should they use debt or should they use the equity, or should they use the mix, and in what proportion should they mix it? And you know your decision will be subject to availability of all of these sources, and most importantly, cost. Likewise, risk appetite will be very, very important. I know we've done this in details in source of capital video. Okay, that is the financing decision. The second decision is the investing decision. So as a finance manager, you are not just going to be looking for the money, but you must be able to advise the company, where should they use the money? Where should they invest in? So investing decision is an area that you must be able to advise the management to say, should we invest in real estate, or should we invest in securities? Should we invest in shares? Should we invest in another company? Should we even be doing the investment at all? What returns do we want? Is it worth it? All of that assessment, which was what you learned in section D of the syllabus, that is your decision to make. This is your section E of the syllabus, financing decision. And once you're able to get the money, you've invested the money. Obviously, the reason why you have done investment is to make returns. So you will make profit. Then how do you return that profit back to the owners of the company? And that is about the dividend policy. So the third decision is about your dividend policy. And that is talking about how do you want to share the profit to the owners of the business. And dividend policies can either be the residual policy, as we have learned before, or the irrelevance theory. And just a brief reminder, the relevance theory is saying that shareholders can make money either from dividend or from share price appreciation. So whether you pay dividend or not, if shareholders are using this theory, they don't mind. Because they know if you don't pay dividend, they will get the money through the share price appreciation. However, the residual theory is slightly different. This one says that you must invest first. You only pay dividend when there is no investment opportunity. So it's only the remnant that you will pay as dividend. Only the remnant. After you've checked the environment, you've checked everywhere, and you cannot find any investment opportunity that is good enough, that is when you're allowed to pay dividend. However, irrelevance theory does not care. You can pay, you can decide not to pay. What the shareholders just want to do is to make money. Where the money comes from, whether it's from dividend or from share price appreciation, they don't mind. Okay, so those are the three decisions that you must be able to make as a finance manager. Now, why are you making those decisions? Remember, you are making those decisions to support the company's objective, which is to support the corporate strategy and the financial objectives. So, which means it's important that you don't only understand your role in terms of the decisions you are meant to make, but also you must be able to understand the corporate objectives. What are the financial objectives of companies? And that will depend on what company are we talking about here. Are we talking about profit-making company or non-for-profit making? Because if it is non-for-profit making, what you are interested in is how have you been able to maximize the funding that has been made available to you. So in that case, you are only interested in value for money. And value for money in that sense, we'll be looking at things like 3 E's: economy, the effectiveness, and the efficiency. For non-for-profit organization, those are the objectives. But for profit making, which is where this course focuses mainly on, you're looking at number 1, which is the most important objective, is to maximize the shareholders' wealth. You want to maximize shareholders' wealth. And when you are talking about maximizing shareholders' wealth, what you are talking about is both increase in share price, so share price appreciation, and likewise ability to pay dividend. So you are looking at prosperity, and you're also looking at sustainability. So it's not enough that you can pay dividend this year, but you must be able to live for many years so that the shareholders can get those dividends many years, and likewise, they can also benefit from share price appreciation. Another financial objective is some companies focuses on maximizing profit. And this is slightly different from maximizing shareholders' worth, because I know some students confuse this with maximizing shareholders' worth. Remember, maximizing profit does not necessarily mean that the shareholders will get dividend, because if you don't have, take for instance, if you don't have cash, you can't pay dividend, even if you make profit. So that's when you need to know that profit comes from accrual and not from cash. So you could have done accrual and all of that, and there is profit, but there is no cash to pay the dividend. So shareholders will not be happy. They can't get the worth because cash is the worth, not the profit. Yeah. Sometimes as well, some management might so focused on short-term objectives, but at the expense of the long-term sustainability of the company, which means they will make profit, but that company might not last. In that case, you are not maximizing shareholders' worth, though you are maximizing profit. And what that means is that you are taking a lot of risk. You are maximizing your risk, which might not also be in alignment with the shareholders' appetite for the risk. So they are different. Another possible objective is what we call satisficing. Please take note of this word because I'm sure you'll probably be hearing this word for the first time. Satisficing is different from satisfying, though they sound similar and probably also interpret similarly, but this is the way we call it in financial management. And what does it mean? Satisficing just means that you are making profit by taking minimum risk. In maximizing profit, you are maximizing risk, but in satisficing, you are taking the minimum risk, but you're still looking for profit. So which means you might not make as much profit as you make when you're trying to maximize profit. And the last objective is the EPS growth. And this is another good objective where companies is focusing on earnings growth. Yeah, which the understanding if a company is focusing on this objective is that if a company is able to grow its earnings every year, there's a tendency that the share price will go every year as well. And with that, if they manage their cash, they might also be able to generate some dividend for the shareholders. So those are the 4 key objectives that companies might be looking forward to achieving. But like I said, the best and the most important one is maximizing the shareholders' worth and not trying to maximize just profit. But like I said, that is for profit making, because you also need to understand what does it mean for non-profit making. And I've told you, for non-profit, their focusing is getting the best from the funding that has been made available to them. And in that case, I mentioned the 3 E's that you must understand because those are the objectives. If they're going to achieve value for money, they must be economical. And what does it mean? Economical means that you're purchasing your resources at minimum cost. You want to make sure that you are paying the least possible cost for anything you buy. The second E is the effectiveness. You must be effective. If you are not effective, you cannot deliver value for that money that has been given to you. You are effective when you're able to achieve your objectives. So this is your ability as a company to achieve the objective that you are expected to deliver. So here we are practically saying that you are delivering on the reason why you have been made to exist. And the last one of the E is the efficiency. To deliver value for money, you have to be efficient. And that means that you are producing, or you are delivering maximum output from the input. And when we say input, we're talking about the resources, the funding that has been made available to you. Lastly, for section A is stakeholders that I'm going to look at. Stakeholders. And who are stakeholders? That's first thing you need to know. What is the meaning of stakeholders? Stakeholders are just a group of people or company that has interest in the company. You have interest in company or impacted. They are impacted by the company's activities. You can categorize them into 3 major groups based on their closeness to the operations of the company. The first one is the internal group stakeholders. You have the connected stakeholders, and you have the external stakeholders. Internal means these are the guys who are sitting inside the organizations. They are involved in day-to-day running, decision making, everything about the company. That is internal. And in that case, we know we'll be talking about the employees. We'll be talking about the management and even the directors. However, connected is neither internal exactly nor external exactly. So it means it's just in the middle. And what it means is that these guys, they relate to the company closely, but they are not really involved in day-to-day running of the business. So they are not involved in day-to-day decision making and all of that, but they still connect every now and then with the company. And the first one there is the shareholders that connect with the business once in a year during AGM. Then you have the customers, and likewise the vendors. And for the external, quite straightforward, those are the ones that are totally outside the company. They are not part of the company, but somehow they have interest in the company or they are impacted by the activities of the company. And the popular one is the government. Those are the guys that collect taxes. Yeah, they want to know your profit. And likewise, the community. Why is it important to manage these stakeholders? Why is it a topic in financial management? First thing you need to understand is the fact that we said these guys have interest in the company or they are impacted by the activities of the company, which means these guys, they have interest, then they have different interests. So their interest differs. So different interest. And when you have almost 10 more people having different interest, you cannot rule out conflict of interest. Because sometimes what you want will be harmful to me, and what I want might be harmful to you. And because this is a real problem, you as a finance manager, you cannot totally switch off from that reality. And in that case, our role as a finance manager is to ensure that the company is able to strike the balance between the stakeholders. And what does it mean to strike the balance? Striking the balance means that you're trying to eliminate or you're trying to reduce the conflict. And you might be wondering, are there truly conflict? Let's look at it. Look at these stakeholders. Take, for instance, employees. What does employees want? They want salaries. That's the interest. They want their companies to pay them so much salaries. But remember, salaries is going to be an expense to the company. So if company is going to give a lot of salaries to the employees, it means that the profit will be reduced. And once the profit is reducing, shareholders would not be smiling. So that is a conflict. Likewise, customers, if you ask these customers, what they want is top quality product at the cheapest price possible. If possible, free of charge. But is it possible for a company to give them top quality at a cheap price? It's not possible. So that will also be a conflict. Vendors want you to pay them immediately. But companies will want to hold on. Management will want to hold on to that money so that they can use it for other things before they pay to vendors. So those conflicts are real. And look at the community. What do they want? They want CSR. They want free road, free park where people can play, community center. They want free schools. They want free hospitals and all of that. But if companies are going to be building all those amenities and facilities for them free of charge, it will impact on the shareholders' profitability and the dividend. So all of that are conflicts, but we must manage them. Even look at the directors, which we're going to be spending more time on. Directors and shareholders. What do directors want? What do shareholders want? Shareholders want sustainability of the company. They want the company to last forever, and they want it to be profitable as long as it lasts, so that they can get dividend. But what directors? So which means these shareholders, they're interested in long term, but directors, they're interested in their bonuses and benefits, which is given to them every year. So in that case, they are looking short term. So you can already see conflict there. Shareholder is ready to make sacrifices for today to get the reward for many years to come. But these guys, they won't make any sacrifice today because their benefit is short term. They want it now. They want their benefit right away. Give it to us now. So which means they are ready to do things that will make them earn so much bonuses and so much benefit, even if it is going to be at the expense of the long-term goal of the company. Take, for instance, if they have to be creative in an unethical manner just to get profit, they will do it. But if they are caught and the company start paying fines, or even if the company loses its reputation and good brand, the shareholders will suffer, but directors will move on to another company. So that conflict exists, and that is why we need to talk about what we call agency theory. Agency theory. And before I talk about the theory itself, who is an agent? Because when we are talking of agency theory, we are talking of the relationship between the agent and the principal, and the conflict between the two. Agent is just someone that has been employed to carry out a task on behalf of its principal. So which means, if I put in a simple way you can understand, principal is your employer. In this case, we are talking of the shareholders. Whereas the agent is the employee, is the party that has been contacted to act on behalf of his principal, and that is the director here. So which means what we are saying is that the shareholders, they have delegated their right, what I will call the stewardship function, control, to the directors. So which means the directors will be the one that will be guiding, leading the company to achieve the shareholders' objective, because the shareholders will not be involved going forward. They will just come once in a while to understand what is going on. So, and once this is done, once this delegation is done, what you see is what I call the separation of ownership and control. Because remember, the owners are the shareholders. However, they have delegated control to the directors. So which means ownership definitely will still remain with shareholders. However, control has gone to the directors, because they are the one that will now be making those decisions on behalf of the shareholders. So this delegation creates separation. Please take note. And once that separation happens, it means that the shareholders, they don't have enough information about the company any longer, because they will only get financial statement once in a year. Because they have less involvement, they will have limited information, and this is called information asymmetry. Because shareholders are not involved on day-to-day again, they only come once in a year to understand what has happened over 365 days. It is impossible. So they're only definitely going to have limited information. And that is as a result of the delegation that led to separation and created information asymmetry. This is what creates agency problem. And that is the summary of agency problem, which means that the agent might not act in the best interest of his principal. So here the directors, the agents, talking about the directors, might not act in the best interest of principal. And the principal here that we're talking about the shareholders. Yeah, because they will be selfish. That is the problem. But we are not here to understand or see the problem. We are here to understand the problem and after provide a solution to the problem. So we should be asking ourselves, how do we resolve agency problem? What is the solution to agency problem? The solution is what we call goal congruence. Goal is your interest. Goal is your objective. Yeah. So congruence means alignment. So which means I will call this for you just alignment of interest. So what you are trying to do is to do things that will give you alignment of interest for both the directors and the shareholders. And what are those things that can give you goal congruence? Majorly, there are two things you can do. And the first one is to give share options. Yeah. So if you give share options as part of directors and management's remunerations, they will start thinking like potential shareholders. Remember, share options means that you are telling someone to say, oh, if you work for me for 10 years, I'm going to give you 1,000 shares of my company free of charge. By that time, that guy will start thinking 10, 20 years to come because he knows that in 10 years, he will become a shareholder free without even paying or buying any shares. And with that, you will start earning dividend and will become perpetual owner of that company. In that case, he will start reasoning like a shareholder and he will not want to jeopardize the future of the company just because of today's bonuses, right? So that will be one of the best solutions to agency problem. Another one is to give benefits that are tied to the share price of the company. So what I will say is you give share price performance related pay. Either it's a pay or promotion. Yeah. And in an exam, if you want to say more than two, you can separate it. Right? But majorly what you're looking at is give the shares and give share price related remunerations. Because once they know that their benefit is tied to how the share price is performing, likewise, they will start thinking like a shareholder. So that is the solution to the agency problem. Yeah. And that also marks the end of section A. And quickly, the section B is what I'm going to touch on now. We need to start looking at externalities in terms of the macroeconomic environment where that company operates. Yeah, so what are the things that influence the performance of a company? And here, the focus is on the global economy. So you're looking at the national, which means the country, and the global economy. This is controlled by government. So for each country, every country must manage their economy. And that is the number one role of the government of that country, trying to manage the economy. And when I say managing the economy, what are they trying to achieve? Which means what are the economic objectives of that government? What are the economic objectives? There are four major objectives that every government aspires to deliver. The first one is to ensure that the economy is growing. So I'll call it economic growth. So economic growth. Likewise, they want people to have jobs, so full employment. They don't want people to be roaming on the streets, jobless. They want people to have jobs. Likewise, they want to achieve moderate level of inflation. And moderate, I'm underlining because inflation is not bad, but too much inflation is bad. Inflation you need to grow your economy. But if it is too much, you are just paying price for no value. And that might run that economy into problem. And likewise, they want to achieve balance of trade. Or some people call it balance of payment. That is talking about import being equals to export. So, naturally speaking, this is what they want to achieve. And how would they achieve this? How? How will government achieve all those objectives? They will achieve those objectives by using two types of tools. And those tools are either categorized as the fiscal policies or the monetary policies. When they are using fiscal policies, what they are using is they are using taxes and government expenditure. And when they are using monetary policies, they are using interest rates, policy rates, or the foreign exchange rate. So these are the tools that they will use to achieve these four objectives. And they can decide to use any of them. And let's quickly summarize them, starting with the fiscal policy. Remember, fiscal policy is looking at taxes, which will be the source of revenue for government, and expenditure is expenses for them. So usually, when they do budgets, they expect money to come in from here, and their expenses will be outflow here. When the inflow from taxes, if it is greater than the government expenditure, which means they have more money, there's more money available, that situation is what you call the budget surplus. If the inflow from taxes is less than the expenditure, then that means they are spending more than they are making. And that is what you refer to as budget deficit. But sometimes you might have a situation whereby the inflow is just the same thing as the expenditure. And in that case, you say that budget is balanced. So that is a balanced budget, which is very rare. How do they use this to manage the economy? Remember, when government is spending a lot, it means that they are building infrastructures, e.g. Look at it like they are building infrastructures. And if they have to build infrastructures, it means that they are spending money. They will be contracting a lot of companies that will assist with that. Those ones will have to recruit people. They will pay salaries. So money is going out to people. Invariably, they are creating jobs. So the economy will grow. And if that expenditure is even more than what we are taking away from people through taxes, it means that the net impact, so let's take, for instance, deficit. Yeah, which means here, more expenditure than taxes income. So which means we are giving to the economy than we are taking away from the economy. And what does that mean for their objectives? Definitely, if you look at the economic growth, economy will grow because we are pumping more money into the environment. So which means there are more money left, that people are creating jobs, people are being employed. Those two, they can continue to create even smaller jobs from the money they are making from those salaries they are getting. And what happens to inflation? You expect inflation to go up. This will increase inflation. So this is also going to expand. So expansionary. So it's going to expand the economy. Yeah, because there's more money. Remember, inflation is about money in the environment. So if you are still leaving more money in the environment, you're not mopping it off, then that means you are increasing inflation. So inflation will go up. And what happens to employment? Employment will also rise, because as you are trying to build more infrastructure, you're employing people. Yeah. However, the balance of trade will be worse. This will be worse. And to be worse because there is more money in the environment. So people don't really have to create what they need. They can just buy, and if they cannot get from the country, they have enough money to import. So there's a tendency to have more imports. Remember, balance of trade is export minus import. But for in this scenario where there is more money left in the system, there is more tendency to have a lot of importation. People have money to buy abroad. So, and that will worsen the balance of trade. Yeah. And likewise for monetary, we can take, for instance, interest rates. Let's say the government decides to reduce interest rates. How does that affect those objectives? Very similar to what we've done. Because when you reduce interest rates, what it means for economic growth is that people have more money. People have access to cheap money, because money is very cheap. Everybody can go to the bank and borrow money at close to nothing. So when people can access funds like that, then they can invest. They can take more risk because money is cheap. So, and once you are investing, people are creating jobs, people are trying new businesses, economy will grow. And what happens? Inflation will follow as well, because money is cheap. There's money everywhere. Inflation is everybody can afford everything. So there will be a demand pull inflation because everybody wants to buy. And what happens to employment? Like I said, there is so much money. People are creating jobs, trying everything possible because they have very minimal thing to lose. Money is cheap. They are borrowing at a very ridiculously low rate. So there will be more employment. And likewise, the balance of trade will be worse because there is so much money in the system and people will just start to import. That will be it for section A and section B of the syllabus, and that marks the end of this syllabus on financial management. Remember, continue to like, continue to share, and turn on your notifications, because intermittently, as I'm working on other papers, I will still be posting solutions to practice questions on FM just to help you ace your exams. Keep practicing questions. I'll be doing some revision classes based on time availability. But remember, if you have any challenge, don't hesitate to reach out. My email is always on the bio. Thank you for all the good and kind words that you have been sending, and let's keep going. Bye now.